money.
I thought I'd bring to you guys today a little bit about my arena, and that is mortgages. And I want to talk to you about questions and things to ask your mortgage consultant. There's a lot of people doing my job, especially right now, because the market, there's a lot of activity going on out there. So what you're seeing is new people coming into the industry or people that got out of the industry when the market was tough and they're coming back in. And so I think it's really, really important that you know the right questions to ask your mortgage consultant to make sure that they're a good fit for you. And more importantly, somebody that understands the industry and what's happening in it right now, has the team that can support you, and has the knowledge of how to walk you through the process to make it successful. So here's the first question I ask. Ask about the approval process. Find out if there's a cost associated with the approval process. There should not be any upfront fees that you pay. You also want to make sure that you're going through the pre-approval, not the pre-qualification stage. So there's a huge difference between being pre-approved and being pre-qualified. A letter that you're receiving that says pre-qualified, basically it's an estimate, just verbal information getting from your mortgage consultant or mortgage representative on estimating what they think that you might be able to approve for. Now, they're asking a lot of questions. They're pulling a credit report in most situations, but because it has not gone through any formal system, it's a pre-qualification. Now, the next is a pre-approval. A pre-approval is a solid loan commitment. Sometimes solid loan commitment, you want to take a look at what the letter reads, and through a pre-approval process, if it says you've been pre-approved by an automated system, you need to have them go through the full underwriting process, because what an automated system does is basically someone is putting it through a computer system to get an automated approval or findings to say that you've been pre-approved. The problem with this is it's based on data entry or data integrity. So if your mortgage consultant doesn't know the information that they're putting in there and it's actually correct, they're reading something incorrectly, they're not sure how to calculate income correctly because they're not an actual underwriter, that can cause some really big challenges when it comes time to move forward for closing. Now, a true approval should have that it's gone through the underwriting process and everything's been completed outside of appraisal and title, anything related to the property. Now, it's important to understand when you're pre-approved based on the information provided at loan application. So just because you have a solid loan commitment doesn't mean that you're going to get that mortgage if you've made any changes at all to your current financial situation. So it's really important to understand that it's only as good as the information provided at loan application. So you need to make sure if there's changes to your employment, liabilities, assets, or anything like that, you're checking with your mortgage consultant first prior to doing that. Talk about loan options. It's important that you understand what your options are. The worst thing you can do is have one option provided to you, because there are multiple loan options, even in this environment where you think that there might not be a lot of financing available. There is. Most situations, you're going to have a minimum of 3 loan options to compare. A lot of times you're looking at maybe 5 loan options side by side in the options that would be available. And a good example might be if you're a lower down payment, you're looking at an FHA 3.5% down payment, and you're always comparing it to your conventional financing. Now, conventional with low down, most of you probably know about mortgage insurance. If you're coming in with less than 20% down, you have to pay it in some form. But what most people don't know is on conventional financing, you have options. You can pay it monthly. You can do a one-time complete buyout. You can do a split. May not make any sense in this program right now because there's not enough time. But pick up the phone and call me and I can get you the information on that. Most important to understand is there's options and you want to make sure that you're looking at all of them. The worst mistake that you can make is to close on a mortgage and find out that a coworker or a friend or family member went with another loan and you're questioning yourself whether you chose the right program or not. So you want to make sure that you're looking at all of your options. Mortgage insurance is a big one to make sure that you're looking at the difference there. Now, also on cost, there are not necessarily as much a difference in closing costs from one lender to another. Maybe you could talk a few $100, $500, $900, let's say, worst case scenario from one lender to the next on actual closing cost. That's not really what you're comparing. What you're comparing is you're comparing the options that are going to be available to you in the process. But here's what a lot of people don't understand with closing cost. There's a multiple of options that you have to choose from in cost structures, as well as multiple interest rates that you can choose from. So let's use today as an example. I'm not quoting any interest rates. Obviously, it's based on a lot of different qualifying factors, but let's just say that an interest rate at 4%. You can get an interest rate of 4%, which is under what the market rate is going for right now today. Maybe the market rate is closer to 4.25%. 4% might be paying additional points to buy it down. 4.25% being at a par to market interest rate. But actually, you can take a 4.5, maybe 4.75% interest rate. 4.75% being a no closing cost loan. So you're getting all of your different cost structures lined out to make a decision on what the best financial choice is for you, and cost structure on interest rates. So you want to look and make sure that you understand that. Ask your mortgage consultant how long that they've been in the industry. Now, you got to get a start somehow. I've been doing this for almost 20 years, and how I got through my first 12, 24 months in the industry, I have no idea. But thank you to my clients that gave me a chance. Thank you to referral sources that gave me an opportunity. But it was rough. And I think I just naive in the process of even not knowing what I didn't know. Almost 20 years later, I realized that you really have to work with somebody that has experience. I would say minimum 5 years is a good amount of time that they've done enough loans to really understand how the process works. I'd also ask who they have supporting them. Now, not to say that every mortgage consultant has to have a support team behind them, but it gives you an indicator as far as, number one, are they doing a lot of business and trying to do it on their own? I think that can be a real issue to get into, because there's a lot of things that are happening during the process. Or if they are on their own and they don't have a support team, then maybe that's because they're not doing a lot of volume, and that might be an answer there for you as well. Again, not enough time during Money Chat. I just like to put a little tease out there for you to prompt you to pick up the phone and give the show a call. Lots of information that I can share with you on mortgages, as well as all of the guests that I have in studio. You can call 1-855-400-1150 or online at themoneyhour.com. Coming up next on the Money Hour, are you thinking about the next life transition? And in the 50-plus generation, life experience has proven that preparation and planning makes a successful transition. Without preparation, hard word for me to say today, without preparation, the transition can be pretty stressful, not only for you, but also for your family. Right here on 1150 AM KKNW after this short break.